Hello friends, this is Vijay Bhambwani. Welcome back to my weekly market outlook video. Last week I told you that I feared volatility and very high volatility would be order of the day in the coming week, and check out what really happened last week. If at all the Nifty made some gains, it was purely because of the gains that it made on Friday, and we are going to take a look at all that and more. However, the hot topic of this week is something that I'm going to discuss with you is whether the RBI's retail direct GSEC scheme, the government securities scheme, which allows investors, retail investors like you and me, to invest directly on the RBI's bond trading platform, will it impact banks adversely? And I'm going to cover that in the segment wherein I talk about the Bank Nifty. So stay with me. This is going to be a very interesting weekly market outlook video. For now, let's plunge in as to what the market roundup window on your screen tells us. What we can see is that the Nifty gained 1.04%, whereas the Bank Nifty lost 2.12%. We're going to come in the Bank Nifty segment as to why. Now, this is something that I've also been telling you in my past videos and on social media. Primarily, it's a function of inflation and the rising US dollar. What should surprise you is that bullion rose in spite of a strong dollar, which tells you that safe haven buying is back again. Now, safe haven buying is something I've been talking about on Equity Masters YouTube video channel. In the description below this video, you're going to find a link to my Equity Master playlist on their YouTube channel, as well as an offer to get a free trading guide in PDF format. Do avail of these two wonderful opportunities there. Subscribe to my playlist there as well. So I've been saying on Equity Masters channel that inflation will be conducive to pushing up bullion, which is gold and silver prices higher. And that's precisely what happened. Oil and gas fell because the dollar strengthened and the markets are calling the bluff of the gas sellers. I think this deserves a video by itself. And here again on Equity Masters YouTube channel, I've discussed many times as to why I feel prices that are being talked about as $100, $200, $300 per barrel of crude oil is likely to not happen, as well as the bull market that people are talking about in gas. So do check out some of those videos there. And of course, I assure you, I'm going to come back and do something here as well. So the Dixie gained, which is the US dollar index, which gained, it is negative for all emerging markets, including India, because they are import dependent and inflation rises when the dollar rises. And the United States dollar, however, fell against the Indian rupee, which makes the rupee a market outperformer. The opening of the retail direct GSEC scheme on RBI's platform to enable investors to buy sovereign bonds, as well as listing of Indian sovereign debt. This is something I talked about in an earlier video, if you remember, that Indian bonds will be listed in global bond indices, which will result in $20 to $40 billion coming into India every year, possibly for the next decade or so. So this kept the rupee strong and the bond markets steady. Inflation also basically was under control, so that cheered the rupee. The market capitalization on the NSE went up by 1.98% last week, which is a good thing to happen, although we should have frankly asked for a lot more. Coming up on your screen is the MWPL, or market-wide position limit chart, which tells you that traders kept on ramping up their exposure in futures, which is routine till the third week of any derivative cycle. Now let's take a look at the index and stock futures volumes. Do remember, these are cumulative figures for 3 concurrent series, which is November, December, and January futures. So the volumes, however, remained below the recent average turnover due to the sheer spike in statistical beta. Statistical beta you may call volatility. Now, this is something, if you remember, I had warned you in my last week's video, and you can see the thumbnail of that video on your screen. We ideally would want turnover to rise with prices so as to kind of convince us that the upthrust is sustainable. Now let's take a look at the basis chart. Now basis is nothing but the premium enjoyed by the futures over spot. On a week-on-week basis, futures premia rose both in the Nifty and the Bank Nifty. I believe this is an improvement in sentiments for the bulls. And I also update this data on my social media accounts every single day. So do connect with me for updates on a day-to-day basis. My social media contact coordinates come at the fag end of this video. Now, let's take a look at the next study which is coming up, which has stood the test of time. And our in-house exclusive study from our statistical model is the impetus chart. Now, the 20-day look-back period chart shows both the indices are falling as far as the impetus is concerned. The Bank Nifty's decline in the impetus is a lot more steeper. Sure enough, that index lost value on a week-on-week basis. Ideally, I would want the price and impetus to rise simultaneously so that the market rally can sustain. However, that's not happening, and right now, there is a little bit of nervousness in the undertone. Now, this study can also be adapted to any individual stock. We use dozens of such in-house statistical studies in our trading model, the IBEX. Remain assured, I'll be sharing a whole lot of studies with you over a period of time in my videos. Now, friends, let's take a look at the footprint of the four different category of traders, what they are doing and how their trades impact the markets. First, let's take a look at the FIIs. Their index futures shorts, net shorts, went up to 94,106 lots from last week's 51,779 lots. Their stock futures, however, rose to 24,032 lots, whereas last week it was 7,911 lots. Let's take a look at the DIIs, the domestic investment institutions. Their index shorts fell marginally to 76,783 lots against last week's net short position of 85,544 lots. Where individual stock futures positions are concerned, their net shorts went up a tad to 15,54,511 lots, whereas last week they were 15,52,566 lots. Where proprietary traders are concerned, and these guys are sharp traders, their brokers own proprietary trades. This is second best after insider trading because they know who's buying and selling. Their their index net long positions went down to 5,973 lots as against last week's 26,668 lots. Their individual stock futures net longs went up marginally to 2,51,230 lots as against last week's 2,49,097 lots. Where retail traders are concerned, people like you and me, their index net longs went down marginally to 46,778 lots against previous week's 50,965 lots. Their stock futures positions, however, rose up to 13,97,383 lots from last week's 13,56,919 lots. So friends, it's very clear that all the heavy lifting is coming from the retail guys, whereas the FIIs and DIIs are seemingly a lot more cautious out there. Let's now go to the 10-year benchmark bond yields. Bond markets, do remember, I've been cautioning you, is the fountain of all money supply. Don't take this market lightly if you're trading banking stocks or even the bank Nifty, and the overall equity markets also get impacted by bond yields. So a very well-rounded trader is somebody who will take into account all variables. Let's see what the bond yield is doing. It was sideways on a week-on-week basis as the rupee was strong and Indian bonds are reportedly due for international bond index inclusion. The opening up of the G-Sec market by the RBI to retail investors is another factor for yields to get narrower. Inflation has come in lower than feared, and it has also helped keep the yields in range. We'll keep monitoring the situation keenly and keep revisiting the bond yields figures day on day. Keep in touch with me for daily updates on social media, and we can basically get a good trading game plan going together. Friends, let's now take a look at the Dixie, the US dollar index, which gained 0.96%. It has now tested the highs it has last seen in July 2020. That's a good 16-month high. The 93.5 levels, which I used to tell you in my past weekly videos, I told you once this level is overcome and the Dixie trades consistently above this level, this will prove to move up like a slingshot, and that slingshot movement has propelled the Dixie higher. The price, as you can see on your daily chart on your screen, the price is above its 25-day exponential moving average, which indicates a month-long holding on cost of bulls. As long as the price is above this moving average, bulls remain incentivized to hold long positions or maybe even add more longs. The short-term moving average will remain positive as long as the price remains above its 25-day exponential moving average. Now we switch to the weekly chart, where we see that the price made a large bullish candle, even though the price actually gained only on 2 out of 5 trading sessions last week. That is Wednesday and Thursday. Now that's a very profound development to watch out for. These kind of big moves don't happen without a reason. Here again, the price is comfortably above its 25-week exponential moving average, which is 6 months average holding on cost. That means the medium-term outlook is also positive. The bulls will hold on to longs as long as the price is above this average. Last week, I advocated an estimated range between 95.15 and 93.25, which was marginally overcome because the week's high was 95.27. Next week, I expect an estimated, I stress upon the word estimated here, range between 96.10 on the upside and 94.10 on the downside. Friends, I suggest you watch this space very keenly because this is an important barometer for the markets, because outlook for energy, bullion, inflation, etc. will depend on the dollar index. Friends, let's now jump on to the Bank Nifty, which fell 2.12%, and it also fell on 4 out of 5 trading sessions last week and badly underperformed the Nifty 50. The price is below the 25-day exponential moving average, which happens to be a month-long holding on cost. Now that puts the Bank Nifty bulls in a very uncomfortable spot. And furthermore, staying below the 38,500 level sustainably might just step up the pressure on the Bank Nifty. Friends, I come to you as to why I said the RBI's recent moves about opening up the G-Sec market might impact banking stocks. Now here is a very simple question I'm asking you. If you are getting 5 or 5.5%, maybe 6% if you're a senior citizen from a bank fixed deposit, and your amount of deposit is insured to a maximum of 5 lakh rupees, which is $500,000 rupees in India, as against the RBI bonds, which are sovereign guaranteed, which means irrespective of the amount you invest in, whether it's 5 crores, 10 crores or 100 crores, the entire money is guaranteed by the government. and your yield is upwards of 6.3%. Depending on which bond and which maturity you're buying at what price, you might even get 6.5% or higher, depending on the price, like I said. Where would a rational investor invest? Obviously, where all my money is 100% secured by the central government of India, I'm getting a higher yield. I can buy and sell on the platform directly from the RBI without commissions and costs. So will this impact? This question is of paramount importance. Will this impact the fixed deposit gathering ability of the banks? Hey, this is something that we need to watch depending on how well the RBI's GSEC bond scheme gathers momentum. I assure you, the high net worth individuals have a nose for money, for profits, for returns. If they start to switch from bank FDs to the bond markets, there could be some withdrawal of funds from the banking space. So we are not saying that the banking stocks are going to fall tomorrow morning. Let's keep our ears to the ground together and watch the signals emanating from the bond market. The coming month or so rather, will tell us what is the kind of response to the RBI retail direct GSEC scheme. If it is good, I believe money will shift out of bank FDs to the bond market. So we are going to watch this space carefully. Now coming back to the Bank Nifty, only once the Bank Nifty daily price crosses over the 25-day exponential moving average should you expect a possibility of a further up move. Let's now go to the weekly chart. We see a large bearish candle. Last week, I drew your attention to the tiny bullish candle contained within the body of the prior week's bearish candle. I called it a pause of some sorts, and I said we need a breakout or breakdown beyond the big red candle's high or low. Well, here you have it. The markets gave its verdict by opening on the downside. The price remains above its 25-week exponential moving average, however, which is approximately 6 months holding period of the bulls. Therefore, the medium-term outlook remains positive for now. In the week before last, this index was at number 3 on the most volatile counters list on the NSE. But it fell by 1 notch to number 4 because individual stock volatility went up. It's not that the Bank Nifty's volatility fell. Now, last week, I advocated an estimated range between 41,075 on the upside and 38,075 on the downside, which held perfectly well in spite of all the high statistical beta or sheer volatility. In the coming week, I expect an estimated range. I stress upon the word estimated here, range of 40,225 on the upside and 37,250 on the downside. Friends, I would advocate you continue to trade light and maintain stop losses very, very strictly. These are extremely volatile markets here. Friends, let's now go to the Nifty 50, which gained 1.04% on a week-on-week basis, and it ended with gains purely because the market rose on Friday. Had it not been so, we would have seen net losses on the Nifty as well on a week-on-week basis. Now the daily chart on your screen shows the price climbing back above the 25-day exponential moving average on Friday. This average price, let me remind you again and again, is approximately 1 month's holding on cost of the bulls. Now, as long as the price is remaining above this threshold, the short-term outlook remains positive. Watch this average very keenly, my friends, on a daily basis. For now, the bulls appear to prevail over the bears and they hold the upper hand. Like I said, for now. The weekly chart on your screen shows a small bullish candle which resembles a hammer, which invariably indicates a tug of war between bulls and bears. The last 2 bullish candles, which are small, remain entrenched in the large bearish candle preceding them, which means the index is coiling up like a compressed spring and it will shoot out in either direction. That move will probably be very forceful and violent as well. Let's wait and watch which way the cookie crumbles. The price remains comfortably above its 25-week exponential moving average, which is approximately 6 months average holding on cost. So the medium-term outlook remains positive. In the week before last, this index was at number 12 on the most volatile list, but it fell 6 notches to number 16 because individual stock futures volatility exceeded the Nifty statistical beta. Last week, I advocated an estimated range between 18,400 on the upside and 17,450 on the downside, which held in spite of higher beta or volatility. In the coming week, I expect an estimated, I repeat the word estimated here, range between 18,550 on the upside and 17,650 on the downside. The range, my friends, might appear wide to you, but this is after adjustment for last week's higher intraday ranges. I continue to advocate that you trade light, hold your trades with stop losses diligently, and focus only on high probability trade setups, my friends. Friends, I now come to the most popular segment of this video, wherein I give you 5 stocks which are low beta, low impetus, and 5 stocks which are high beta, high impetus. In the high impetus, high beta stocks, you take a small exposure, wait for big price moves. And low beta, low impetus stocks, you take a bigger exposure, wait for small price moves. Different traders, different mindsets, and therefore different techniques. So the high beta list is led by Star at number 1, number 2, Bharat Electronics, BEL, number 3, Mahindra and Mahindra, number 4, Navin Fluorine, number 5, Coforge. Now for the 5 low beta, low impetus stocks, the list is led by IRCTC at number 1, number 2, Biocon, number 3, Axis Bank, number 4, Ramco Cements, and number 5, PNB or Punjab National Bank. Friends, this hierarchy of high and low beta stocks can change hour to hour, day to day, which is why I request you join me and connect with me on social media on my contact coordinates coming up at the far end of this video. We can get conversations going, help each other become better traders out here. Friends, it's time for me to say goodbye. Thank you for your patience. Thank you for watching my video. Do subscribe to my YouTube channel if you haven't already done so. Click on the bell icon to receive instant alerts about fresh videos being put up out here. In the comment section, do let me know how my videos are helping you become better traders. And please forward this video to your family and friends and help me reach out to more and more like-minded traders out there. Thank you for your patience. I wish you have a very, very profitable week, my friends. Take care till we meet again in my next video. This is Vijay Bhambwani signing off for now. Bye-bye.